Bond traders are upping their bets on a Treasury rally, sparked by expectations of Fed rate cuts. Leveraged positions in Treasury futures rising to a record high ahead of the Fed's annual economic symposium in Jackson Hole. So how big of a catalyst are rate cuts to the bond market? Let's discuss that with Collin Martin. He's Schwab Center for Financial Research's fixed income strategist. Collin, it's great to have you here. So we certainly have seen a rally in Treasuries. I think the question is, what more does that rally look like if we do get a dovish signal on Friday? How do you think the bond market is going to react?
Well, thanks for having me. If the Fed cuts rates as we expected this year, and we're pricing in about 3 rate cuts by the end of the year, we don't think a 50 basis point cut in September is necessary as of now. But if those expectations come to fruition, we continue to expect a bull steepening of the yield curve, where we think short-term rates and some intermediate-term rates will continue to fall. But we're not sure we'll see too much downside with, say, longer-term yields, because if we are still in a soft landing environment, which we think we're probably still in right now, although we're seeing some info that things are slowing, for the most part, the economy is still growing close to trend. So we see less downside for long-term yields, and at around 3.8% on the 10-year right now, we think that's close to fair value. And we expect to see short and intermediate term yields fall a lot more, especially on the short end of the curve. That's the biggest thing we're telling our clients here at Schwab, that once those rate cuts become a reality, short-term yields are expected to fall and reinvestment risk becomes real.
Yeah, and you're seeing yields under pressure as we continue to await these jobs numbers and revisions from the Bureau of Labor Statistics here. But I'm curious about where you can find the best opportunity across the curve, particularly as we do await more information on the path of the Federal Reserve's rate cut cycle moving forward. If investors are looking into bonds, where's the best opportunity?
The guidance we've been providing our clients is to think beyond treasuries. And a key reason for that is because yields have fallen so much over the past few months. We've been talking about the idea of extending duration for close to 2 years now. And by that, we meant considering some intermediate or long-term bond investments, including U.S. Treasuries, because of the high yields they offered. But now with the 10-year yield close to 3.8%, and assuming that the Fed cuts rates but not back to zero, maybe it gets to that 3% area or so, the risk reward isn't as attractive to get into a 10-year Treasury or 7-year Treasury, something like that from a tactical standpoint. So when we say think beyond Treasuries, there's an area of opportunity with investment-grade corporate bonds. You can still get yields there close to 5%. I think that's really important for a lot of investors, a lot of our clients, because 5% is a bogey that they may have in their heads. It's yields you can still get on short-term investments like Treasury bills or CDs or even money market fund yields, but those are temporary. And if you can match that income stream, still get 5% or close to 5% with highly rated investment-grade corporate bonds for a longer period of time, we find that to be pretty attractive right now. So investment-grade corporates are one of our preferred areas to kind of move out of the short end of the curve and lock in high yields with more certainty.